Is the real estate market on the brink of a collapse worse than 2008? And if so, will Southwest Florida be able to defy the odds this time? Stay tuned for this week's housing market update for Southwest Florida and my 2024 market predictions. Hey, my name is Rick Harrison with MVP Realty, your guide for buying your first home in Southwest Florida. And today, we're at a potential turning point. You've seen the headlines. Home affordability is at an all-time low. Inventory and foreclosures are skyrocketing. Renting is now cheaper than owning. Layoffs ticking up, and a trembling $2.2 trillion commercial real estate bubble. It's a whirlwind of uncertainty. But amidst this uncertainty, two crucial questions remain. Are we on the cusp of a real estate market crash worse than 2008? And in this scenario, is the Fed set to lower rates in March? These questions aren't just national concerns. They're especially vital for understanding the future of the housing market right here in Southwest Florida. Now, before we get into those stories, let's take a look at where we are today and what's changed over the last year so we can look at today's stories with some context. So starting with the Lee County trends, we're going to look at the week-over-week changes, and then we're going to look at the annual changes year over year. So first up is the new listings. That's at 902. That's up 7.3% from last week. Solds are also up almost 7% at 281. And then we have pendings, which is what's going on in the market right now over the past week. That's down 2.6%, which isn't a whole lot, but still, there's a ton more new listings that are actually going pending. So that means inventory is still growing. Right now, the key stat that we want to look at, though, is the median sales price. Everybody's predicting, a housing market crash and prices, declining. Some argue that a crash takes years, so it's slow. But right now, you can see that the median sale price is still increasing right now for Lee County. 404.9 is where the median sales price is for Lee County. That's up 7.7% from last week. The median listing price is also up. So that means that sellers still feel pretty confident in pricing their home above the market right now because people are paying it. So that's up 6.1% to 459,000. Days on market is actually decreased recently, and that has more to do with the interest rates. Over the last couple of weeks, we've seen interest rates dip back from their all-time highs at 8%, now in the 6.5% range. Because those interest rates dipped, more people entered the market, started buying. That's why you see more solds up. So that's actually down almost 20%. Now, as we look at the year over year for Lee County, new listings are at 3803. So that's quite a large increase here. 36% year over year increase. Solds are down 11.5%. And then pendings, that's new buyers coming in, that's up 1986. That's up 10% from last year. So you can see that the market is still pretty hot. People are still buying, and the median sales price again here, 388. So that's up 2% year over year in January. Median listing price up 5.2% year over year to 457,000. And then days on market, this was a huge increase because a year ago, things were barely staying on the market for a day or two. Now we're up 52 days. For those of you that are sellers, just be aware that the homes are sitting longer. It's not your house. It's just there's less buyers. Prices are high, interest rates are high, so people aren't buying as quickly. All right, moving on to Collier County. So this is Naples, Marco Island, Immokalee, down in the Naples area. So new listings also 497. That's up 14% week over week. Solds 121. That's up 16% week over week. And then pendings again down 261. That's down almost 10%. So you can see here less buyers entering that market. Collier is a little bit of a different animal than Lee County. Prices are a lot higher. As you can see, the median sales price here, $673,000 compared to the 300 to 400 thousand price range. 673, that's up 5%. So you can see median sales price, people are still buying, and the prices are still going up on those sales. Median listing price, 774. That's actually up 3.3%. I didn't switch the arrow on that. So that's up 3.3%. And then days on market, also that's down now. Now let's look at the annual year over year, January 2023 to 2024. New listings. We had almost 2,000 new listings in this January. That's up 30% from last January. So you can see inventory has increased. Solds are down. Less people were buying. Interest rates have been up. So that's down 11%. And then pendings were almost up 2%, 10% as well. So again, you can see just this past month, more people have decided to buy than they did last year in January. Median sales price, 640,000. That's down 2.4%. I'm sorry, that's up 2.4%. And then median listing price is down 2.1%. So what people are actually selling them for is higher than what they're actually listing them for in certain places. Days on market, again, that's up 53% from last year. That's a huge gain. But again, that was because things last year were only staying on the market for a day or two. All right, now let's look at the current inventory. This is total for all of Lee County and Collier County. Single family homes, the number on the left underneath, 8.7%, that's down. That's week over week. So single family inventory is at 7859 this week as of right now. So it's down 8.7% from last week. It's up 31% from last year. Same thing with condos. Condos are up 2.2% week over week, and they're up 83.3% year over year. So those are huge gains. You can see there's a lot more inventory on the market. And that is what is causing some of the prices to be a little spotty here. Foreclosures, 38 new foreclosures, that's down 7 now. And then interest rates, the current average interest rate across the US right now is 6.43%. Although as of today, the 10-year bond did jump quite a bit and it went back up almost to the 7% range. So I do expect the interest rates to be rising again, probably as we're speaking right now. Average rent, that's almost $2,000 a month, and that's for Lee County. So when you go to Collier County, you're looking closer to $8,000 depending on what size. The average rent right now for Lee County at almost $2,000. That's for a two-bedroom apartment or condo. When you go to Naples, depending on the area, again, some of those areas, the average can be around $8,000 per month, especially now that we're in season. All right, and this is, for those of you who are new to the channel, I go over the interest rates every week, where they're going next, and there's an easy way to do that. You just look at the 10-year bond on any of the stock market indicators or websites you can go on. You can look at the 10-year bond, and that's gonna tell you approximately where interest rates are going for mortgages. So as you can see right now, this was a snapshot from earlier this morning. You can see the green bars at the end here going up. Those are going up to that white line, which is a 200-day moving average. That green indicates that the 10-year bonds yields are going up. Basically, that mirrors what is going to happen with mortgage rates. You just add about 2.5% to them. So right now we're at 4.1%. So you add about 2.5 to 3% to that, and that tells you where we're going to be for mortgage rates. So that gives us indicator we're about 6.8% or so. And now that brings us into today's stories that I wanted to go over. Foreclosures has been a huge issue that people keep bringing up that say that this is going to be a crash. I love seeing all the YouTube videos with the foreclosures, crash imminent, all that stuff on those videos. And then I go through and I look at, what data are they presenting? And they're using the same data that I'm presenting right here. US foreclosure data. ATTOM data is one of the leading sources of data, non-governmental data, that looks at foreclosures very closely. It's one of the biggest things that they track. Now you can see back in 2008 and 2009, 2010, that's where we had our peak, and that was at 2% was the foreclosure rate. We're way down here at 0.26%. So if we scroll down here, you can see 357,000 properties with foreclosure filings in 2023. That's the whole year, represented a 0.26% of all US housing units. That's nowhere near the amount of inventory that needs to happen, really, for prices to crash or come down any significant amount. So unless something drastically happens, which it sounds like layoffs are happening, I think that's going to have, it's going to tick up, but we're still below pre-pandemic levels, and those were historic lows at the time. Also, the $2 trillion commercial debt, that was a huge issue that people have been talking about. So what does that mean from the industry? So we're actually going to listen to a quick little video here from Ken McElroy, who, if anybody knows who Rich Dad Poor Dad is, Robert Kiyosaki, he was the real estate guy for Robert Kiyosaki, and he's got some great insights, and he does a lot of research. He's a billionaire, by the way, and you're going to get a lot out of this.
It's definitely going to affect, as I said, we're moving toward a renter nation, and there's some things that are really super clear to me. One is housing prices are not going to go down, and rental prices are going to be flat for about a year and a half, and then they're going to go up like crazy. Yep, go
So
ahead.
I know you think that, but I want to challenge you because you mentioned that when somebody had asked, "Why will this affect, the housing market?" You said it would affect it. So if you're saying that housing prices, you don't see them going down, how do you see it affecting it?
So I guess it depends on what I mean by affecting it, right? For me, it'll be less affordable.
Okay.
Yeah,
See, I
affordable.
think a lot of people thought you meant the other way. So
No,
I think that
well, right. So I think of the consumer. When we're talking about this, I think of the people, not necessarily housing. I mean, housing is going to do its thing. We're talking about here is layoffs. And there's going to be less people that can afford stuff.
So essentially, what he's saying is almost opposite of what a lot of the crash people are saying. A lot of people are saying because of the inventory that's been increasing, and then we also have now a huge amount of layoffs that seem to be coming down the pipeline. We have foreclosures starting to tick up, that all of those things are going to be that black swan event that brings a ton of inventory to the market, and that's going to lower prices and cause the crash. What he's saying, on the other hand, is that the unemployment may be happening and there are going to be a lot of layoffs, but that's going to make things less affordable. He thinks we're moving into a renter nation. And that, honestly, that's what a lot of the people, a lot of the talking heads have been saying. If you've listened to the World Economic Forum 2030, they're supposed to be, you will own nothing and you'll be happy. Well, that goes right along into renter nation. And because asset prices have continued to balloon, and that really comes down to the dollar buying power has declined so much. It's like 90, almost 99% since we first implemented it. It's decreased that much. That's what is causing inflation. There's so much money in circulation that the value of the dollar has continued to decline. The more money you put into the economy, the less valuable that $1 is. So when that happens and inflation happens, asset prices balloon because it takes more dollars to buy the same thing. So if you're looking to get ahead, if you're looking to get wealthy, if you're looking to own your own home, you should buy an asset that's going to appreciate with inflation. And that's what we're in right now. We're going to be seeing inflation for the rest of the year, it sounds like, based on what the Fed is saying. So if that's the case, then you know that your asset is going to continue appreciating in price. So he sees us going into a renter nation. I agree with him. I think if you can buy a house, you shouldn't wait too long. Again, 2030 is quite a few years off, but things are going to get more and more expensive. Inflation is not something that's going away right away. That's my 2 cents. The other thing to think about, we're in a different, our state is a little bit different than it was back in 2008. I mean, I think the state of Florida has always been a hot spot for people who want to go there, and it has been a little bit of a swing state as far as real estate goes. 2008 crash affected Florida quite a bit, but more so over the last several years, more and more people are coming here, and it's not just everyday average people who are looking to start their life over here. We're talking about wealthy people who are moving from California, Chicago, New York, New Jersey, Boston. They're moving from major metro areas where the cost of living is already extraordinarily high compared to what they're used to paying. It's nothing. Now, this article goes into Texas and Florida snag 70% of the top 50 master plans in the United States. 70%. And a couple of them are right here in our area, Babcock Ranch being one of them. On top of that, we also have wealthy millennials migrating to the two states, which are Texas and Florida. So the report considers anyone between the ages of 26 and 35 years old to be a millennial, and those with annual incomes of 200,000 plus as part of the target cohort being measured. And then finally, this is the real kicker because this is what most of this stuff hinges on. Powell, this was from one of his 60 Minutes interviews. He's weary of cutting rates too soon. And that, again, all goes back to Volcker back in the 1970s. They're afraid of making the same mistake where inflation picks back up and crushes the economy. So despite national headlines painting a grim scenario, our local market stats and trends tell a different story. With the current mortgage rates update in mind, we see that Florida, particularly our region, is positioned to remain a strong housing market for the remainder of the year. Yes, some markets are adjusting or correcting, but the overall trend is resilience. As we examine the ongoing developments, it's clear that buyers currently hold more leverage. Inventory is increasing, and in some areas, prices are plateauing or even dipping slightly. This situation, however, is delicately balanced on the Federal Reserve's decision right now regarding interest rates. The anticipation is that the Fed will likely hold off on rate cuts until the end of the year. This decision is crucial as it affects the flow of both sellers and buyers into the market. A rate cut could reignite the market's momentum, potentially driving prices up unless an unforeseen event or a black swan event introduces a surge in inventory. So what does all this mean for you as a buyer in Southwest Florida? Well, the current market offers a unique window of opportunity. With growing inventory and stable prices, now could be an ideal time to find your dream home or make a strategic investment. However, you do need to keep an eye on the Federal Reserve's moves, as the market dynamics could shift very quickly. Remember, these trends and predictions are a compass, not a map. Every decision should be informed and tailored to your specific situation. So if you're considering buying a home in Southwest Florida, staying informed is key. So I encourage you to subscribe to this channel. You'll get the latest updates, insights, and tips to navigate the real estate market confidently. Thank you for watching. I hope to see you in the next video, but until then, stay safe, stay positive, and more importantly, stay free.